Kyle here with Factum Financial, and on today's video, I'm going to be breaking down the three biggest misconceptions when it comes to identifying whole life insurance that most people have a big misunderstanding. It's why they have such a hard time grasping this concept of infinite banking and why we would use an asset like whole life insurance as our primary banking tool. So before we jump into that, let's go to an idea that I'd love to share. It's that the perfect life is having abundance in all five of these areas: spiritually, personally, family, financial, and in your occupation. Now, I'll tell you, I love what I do as an occupation because I get to teach people how to win in the financial area of life. And one of the ways that you can win is by understanding whole life insurance properly and the infinite banking concept. And the only reason I would want to teach you and coach you and help educate you on how to win the money game is not just so you can have more money. It's so that you can go out and fund the missions in the other areas of life. And that's when you're going to be waking up and enjoying every second of every day. So let's jump right into this. The biggest misconceptions that we hear commonly about whole life insurance are these. It's got a low rate of return. It's expensive to own. It's literally the worst investment of all time. And the reason it's the worst investment is because it's got a low rate of return and it's so expensive. Literally no one should buy this garbage product. Verbatim, that is what I was told over a decade ago when I was buying my first whole life insurance policy. So if you are actually looking to get educated and you've got an open mind, you're not just going to listen to the noise that exists out there, because I think there's two types of people in this world. There are those that judge something before they've ever tried it, and then there are those that are willing to take action, try something new, and base their opinions off their own results. And that latter one was me. I was willing to go against the grain, buy this asset, see how it formed over 10 years, and I'll tell you, I've absolutely loved it. And I will say the biggest misconception that people have, and it keeps them from getting educated and understanding this asset and this product or this process properly, is that whole life insurance is not an investment. If you're watching this video, or if I was teaching this live, I'll tell the audience, write this down 2 times because it's so important. If you can't stop looking at life insurance like an investment, you'll never see the power and the benefits behind that as a foundational wealth building vehicle. So let's break this down. This book, Becoming Your Own Banker, gets lumped into whole life insurance because in this book, written by Nelson Nash, an amazing thought leader and pioneer of this concept of infinite banking, and he said in his book that he recommends a properly structured whole life insurance policy with a good mutually owned life insurance carrier. My preferred favorite is One America. And there's a reason that we choose whole life insurance as the primary banking tool. So think about it this way. This book, Becoming Your Own Banker, this is more of a mindset. It's not an investing strategy. It's a mindset around how much do you understand about the world of banking and how much of that do you want to own and control in your life. We're going to get to that in just a minute. Next is, if you're going to become your own banker, there are rules to the banking world that you want to follow, and we would recommend getting a copy of our Tough Money curriculum, which is a financial management workbook that'll supplement a lot of the concepts being taught in Becoming Your Own Banker. And lastly, if you insert the right product or tool into the mindset of becoming your own banker, following the right rules of banking, and then you have the right tool that's going to be your primary banking tool, that is what unlocks what we'd call more of a magical experience with this process. There is nothing fancy or magical going on. It may seem like that from a lot of terrible online marketers, and it's why you need proper, solid education. So if you have not read this book, don't listen to any of the noise until you've read this book, because literally on one of the first pages of this book, Nelson Nash says, Becoming Your Own Banker, the Infinite Banking Concept, is a course for a 10-hour course of instruction around the power of dividend-paying whole life insurance. This is not a sales tool. This is an educational process that you really need to take some time learning. And right on the next column, this book is not about investments of any kind. It's about how one finances the things of life, which can certainly include investments. It's not about rates of return. And so this is a very important fundamental piece to this. This is why I tell you, you got to write that down 2 times. Whole life insurance is not an investment. If you can't get past that, you're going to be wildly confused on how to look at this, and most people are. So let's jump ahead. In this book, Becoming Your Banker, Nelson Nash identifies what we call the problem. And the problem that I was not exposed to until I was 25 years old, and I read that book and I really started thinking about the world of banking, is this. We finance everything in life. It's a concept that he teaches over and over inside that book. And what that means is you either borrow money and you pay interest. We call those interest payments. So if that's you and you're kind of like, oh, I don't want to pay interest payments, you probably grew up like I did. I grew up in the pay cash family, more of the Dave Ramsey methodology. And it was the reason we pay cash because I don't want to pay anyone interest payments. But no one had ever taught me about what's called an interest cost. And that means when you pay cash, you don't just give up that cash, you give up what that cash could have earned you for the rest of your life. And the problem here is that whether you're financing and paying someone else interest or you're paying cash, either way the money is financed and transferred away from your control, and it ends up in someone else's banking organization. It doesn't have to be, but it is because of the way we think. Now, here's a quick example from a software we're going to see a little bit later as well, called Truth Concepts. If you're working with an insurance agent, I would highly recommend they attend and get access to Truth Concepts software and attend multiple Truth Concepts training. This helped me bring the mathematical certainty to a lot of the concepts that we teach here at Factum. And so basically what we're seeing here is a present value. If you were to use $30,000 of cash and you could have earned around a 4% return on that over a 30-year time period, the lost interest cost or that potential future value was $97,000 for that financial decision. It doesn't just cost you 30 grand. It costs you what that 30 grand could have earned. So this is happening with every single financial decision we make. And that's where a lot of the power of the infinite banking concept comes into play, is when you understand you can actually control and harness that interest cost on your side of the equation. By the way, we have not said or talked about the concept of investing not even once so far in this video. We're talking all foundational concepts, all banking principles. So let's jump further. In order to understand where does this asset of whole life insurance and the process of becoming your banker exist in my wealth plan. In order to know that, we've got to review some of the key components of wealth building. Now, we're a big educational company here at Factum. You probably know that by now. So we teach heavily around financial education, which leads to financial awareness, which is where our Tough Money Workbook really helps people get that financial awareness. And we focus so heavily on helping Americans build a really strong, tough saving strategy. And having a strong saving strategy and tough money management habits is one of the prerequisites to implementing and being very successful with the infinite banking concept, which is a foundational concept. Now, how tough your foundation is will dictate how far you're able to go with this idea of freedom in your life. And everyone's idea of freedom in their life is drastically different. Now, in between the foundation and the very tippity top of what ideal freedom looks like for us, we're going to find key components. Now, what's interesting about this portion in green that we're looking at right here, whether you make $50 million a year or $50,000 a year, you need this exact same wealth foundation in place. You're going to need education, awareness, strong saving strategy. You're going to need certain insurances in place. You're going to need to understand your debt strategy, asset protection, taxes. You're going to need to know and understand all of these elements. And it's why you need a wealth team. Now, most people, when they come to learn about financial education, all they want to do and study is the investing. Now, there's nothing wrong with that. But these two go so hand in hand, foundation and wealth acceleration. Now, what's interesting about the gold piece on top, your cash flow management system, your investing strategy will look wildly different than anyone else because we all have a different idea of what freedom looks like. So your investing strategy has to be very catered to what you're trying to accomplish when it comes to freedom. And so think of the foundation as non-negotiable. You have to have these elements. That's why Factum exists. And up on the top, once you're tough with your foundation, you will be so much better prepared to invest very intentionally in things you don't understand that support your ideal life. Now, every one of us in the United States operates in those two worlds, foundation and acceleration. But there's another force and another component in the big wide world, and it's called banking. And banking infiltrates and influences every single component of those wealth items there. And it's worth a few hours of your time to go deeper and study this concept of banking and how it affects your finances, okay? So let me put it to you this way. We've all been the saver, we all are aware that there are bankers, and we've all been the borrower. The question is, who do you want to be? Because here's what's happening. We go to work, we make money, the savers save money with the bankers. The bankers have positioned themselves very strategically between employees, self-employed individuals, business owners, and investors to take in these deposits. Now, the bank lends out money to borrowers, and who are the borrowers? They are employees, self-employed individuals, business owners, and investors. And the borrowers pay back the bank at a high interest rate, and the bank turns around and pays back the saver at a much, much lower interest rate. Very simple business model. And this simple business model has created some of the wealthiest companies in the entire world with just this model. And so the question is, well, what if you became the banker? You see, if you're the saver, you also become the banker, and you're the borrower. Essentially, you create what's called a closed economy. Now, this has nothing to do with rates of return or investing. This is a control conversation. Here's another way to look at this. We're all depositing money in the bank, but the question you should be asking is who actually owns that banking function? So we deposit money with the bank. Let's assume the bank's going to pay us some type of yield on our savings. We'll call it 4%. Now, the bank is going to go out and lend money, and we're going to buy houses and pay a 6% mortgage, and the bankers creating cash flow. They do this with vehicles. They do this with business and investing. They do this with credit card debt. And all we're saying is, what if you just replace that commercial bank with a life insurance contract that now you own and control, and now you could facilitate all of these things, not that you might do, but you have to do in your lifetime. And that's kind of getting into the essence of what the concept of becoming your own banker is all about. Highly recommend picking up the book, read it, and not only read it once, because you're going to read it once and certain things are going to jump out to you. And as you actually start implementing it, now you're going to see it a different way. So when you go back and read this after you've owned whole life and you've been working towards the infinite banking concept for a few years, you're going to go back and read it, and you're going to learn new stuff, and it's going to speak to you differently. And this is why that's just personal development, right? So the more you grow and get better in the money game, the more you'll understand and see the genius and the simplicity behind that book. So let's shift gears a little bit. This is straight out of Nelson's book, and here's where the concept of banking gets really interesting, because what we've been told in the big wide world is to do one thing, option one, which is automatically save into your retirement programs. We're taught to automatically save, we're taught to automatically invest into retirement programs. And so we should have been taught to automatically save and then intentionally invest, but it's typically the backwards way for most Americans. And I'm convinced that's why most Americans, even though we live in the wealthiest country in the history of the world, are not any closer to becoming wealthy or retiring or achieving what they call financial freedom. So let's break this down. About 20% of the American take-home pay will go towards some type of automobile payment, purchase, insurance. It's all lumped into there. About 30% of their take-home pay is going to be going towards housing. That leaves 45% to living. Some of us we don't want to brag, but we're semi-professional spenders. We're about to go pro. And then it leaves about 5%, which is currently right at about the national savings rate. Now, what most of us have been told is, hey, great, you're saving 5% of your income. Take that 5%, put it in more risk, go to the stock market, get retirement vehicles, wait it out, play the long-term game, and make that 5% grow into your $1 million nest egg or whatever you think you need for retirement. The world of banking is saying, are you not looking at the left side of this equation? What if we change some of your financial management habits? What if we became stronger savers, more intentional with our debt? What if we controlled more of the dollars that were flowing through our hands for things that we have to do anyways? Doesn't it kind of make more sense to go focus a little bit of time on the 95% that's leaving our household every single year? And when this paradigm shift goes off, you understand the banks don't want us focused on that. They want us focused on just the right side, which is the savings. They don't necessarily want us knowing, hey, you could do what we're doing. You could just do it at a you and me family type of level. So let's talk about banking and investing. This is, once again, one of the biggest misconceptions is that this is a terrible investment because the low rate of return and it's expensive product to own. So here's my definition of investing, which is a verb. When you go to invest, here's what you're doing. You are intentionally separating your control of money. So you got money in some type of environment where you control it. Call it a checking account, a savings account, whole life insurance, whatever it is. You are going to move that money away from your control into some type of investment or asset. So there's a separation there. And as long as you're a good investor, you have a high expectation that that money returns with new money in the future, okay? So investing is all about acceleration and creating new money. Now let's go to my definition of banking. Banking is also a verb, and it's the exact opposite function in the money game. You see, banking is about intentionally keeping your flow of money permanently, that's a key word there, in an environment where you have complete control and accessibility. You see, when you combine this idea of banking, becoming your own banker, and you understand it's a foundational wealth conversation around control, when you understand that and you pair it with your intentional investing strategy, you are going to see a brand new world of opportunity that you were never exposed to. And it's why you'll hear people say, when I read that book, I could not unread or unsee what I was starting to understand. You'll never go back to learning about money the same way again or thinking about it the same way after you get into those concepts. All right, so whole life insurance is a foundational asset because of the benefits and the characteristics it has. So I still to this day have not found one other singular asset with more permanent benefits built into one place, which is why I would say whole life insurance is the toughest asset you can own at your foundation. And the reason it's so tough is because you get a contract for the rest of your life from a very reputable insurance carrier that has some of the best track records of financial success that we can find. They're giving you a guaranteed contract that certain benefits will be in your favor your entire life. So if you look at just the first few benefits, guarantees, constant compounding of your savings, liquidity. What constitutes a savings environment, which is very different than the function of investing? In order to qualify for a savings environment, the asset needs to be extremely safe and it's got to be liquid. So I'll put it to you this way. You would not put every single dollar you had in the stock market or in real estate or some other asset that could go up or down in value, right? We just wouldn't do that. But you would put all of your money, and you do, into some type of checking account or savings account because we know it's not just going to lose 30% overnight. It's there because it's liquid, it's accessible, and it's safe. And once it's there, we deploy it into different assets to increase different benefits like return, privacy, whatever that is. And the reason whole life insurance is the perfect tool for banking is because it is so liquid, it is so safe, it is private, it comes with death benefit protection. By the way, you have a 100% chance of passing away. You're going to see your cash values actually grow every single month on a guaranteed basis, something that we may or may not see our savings accounts do in our other liquid safe assets. There's a loan provision on this that gives you the most flexibility when playing the money game. That loan provision is such a wonderful benefit, but it's only one of the 8. And then you get a competitive yield, which is a consistent, predictable, keyword here, net growth for your entire life. So let's take a look at one of the policies that I've had. This is the first one I actually bought, 2015. This thing is going on 11, 12 years old right now. And so if I pay in $8,000 in premium in year 13, that policy is going to grow by $13,000 that very next year. No risk, doesn't matter what the stock market's doing, it's a non-correlated asset. Or it grows $1.63 for every dollar I put into this. Now, here's where you pair this with your investing. You see, if I can go out and buy cash flowing real estate, and I can make $8,000 in cash flow from that property, where do you think I'm putting that $8,000? Into a checking account? Absolutely not. I'm going to send it in the form of premium to this life insurance contract that's going to earn me an extra 63 cents for every buck I put into that thing. But this takes a little bit of time to get this thing compounded. You're not going to see returns like this if you've just started this 6 months ago or 3 years ago. Compounding rewards the consistent individual, not the early one. Now, year 28, if we go another 15 years out, and the reason I'm using 15 years is because I think every American has a legitimate shot of being able to retire in a 5, 10, or 15-year time period. But because the lack of education and we have no awareness around our finances in the United States, we're doing things that are literally the opposite of how the money game was intended to be played. We got to focus on cash flow, and controlling a banking source in your life will help with cash flow tremendously. So in year 28, I'm going to pay the same $8,000 in premium. I call that savings. It's going to grow by $24,000 a year, or $3.10 for every dollar I put into that. So if times are good, this is awesome. If times are bad, this is also awesome, because I have accounts and policies that are always performing. It allows me to be a patient investor, wait. And so when opportunity presents itself, remember, this is very liquid. I can get access to this via that loan provision, and I'll go make the investments. If we go out to another 15 years to year 43, assuming we drop this thing down to the minimum premium schedule, which is like $2,600, I put in $2,600 that year. It grows by $36,000, or $13.50 for every dollar I'm putting into this. So let's look at it another way, because what we hear about this, the big three: low rate of return. That policy I just showed you, here's the snapshot of it online. So you can see like my guaranteed cash, the cash value paid up additions. This policy has a long-term internal rate of return of about 3 to 4%. Now that's a net rate of return. I'm going to break that down for you in a calculator in just a second. But this policy that's got a little over $100,000 of cash value is growing $500 a month, and that's net of any taxes, by the way. And that number only goes up. I cannot find a bank, or have not found a bank the last 10, 11 years I'm doing this, that would pay me anywhere close to that by leaving $100,000 liquid. Now, next thing we hear, it's expensive to own. Just buy term, invest the difference. Term is so cheap, whole life is expensive. You see, term is cheap until it's not. Okay, so 99% of term policies don't pay out. That's why it can have such a low premium. By the way, I own term and I own whole life. You buy them for very different reasons. So if I live past the term period, which statistically I'm very likely to live past that, that term just became some of the most expensive insurance I will ever own, because every premium was a pure expense. Now, what we hear about whole life is it's super expensive. Well, I've paid about $98,000 of premium into that policy. I've got $103,000 of that available as cash value, and I have a guaranteed death benefit of $730,000 that goes up every single year. So I have recouped and have available over 100% of my premiums in this policy. This is by far the cheapest insurance I will ever own in my life. I do not have health insurance, home and auto insurance, any other type of insurance where I have recouped 100% of the premiums I've paid into that, and it's growing like it is. So when you start to understand this, now you know whole life insurance is not an investment. It's a foundational asset. It has some really interesting, compelling benefits built into one place. And if you hold it long enough, you're going to see, and this will become one of your favorite assets on your balance sheet. Now, here's basically what's going on. Here's the path of money. There's 4 things we can do with money when it comes in. We can spend it, we can donate it, the rest is called savings. So life insurance exists in that third option, where we save and hold cash reserves. It's a liquidity conversation. It's a foundational asset. It is not an investment. But because of how efficient it is and those benefits, that policy helps me when I have unpredictable income, because it's always growing. It helps me with excessive spending because I don't need to pay premium. I want to pay premium. You know how easy it is to pay $8,000 in premium when you know it's going to grow $13,000 next year, regardless of what's going on? That's the easiest place ever to save money. Less reliance on credit. If you're just tired with dealing with some of the bank's shenanigans and everything they ask for, this is going to be the system to you. That was one of the things that was intriguing, is I wanted to build my own family banking business where we had the control and the say, and our values were instilled in our money principles. It's a big stewardship and leadership conversation. Next is lack of liquidity. It's really easy to hold on to cash, and I'm going to show you some numbers in just a second, when your policies quite literally will beat a lot of actual investments over time. Remember, whole life's not an investment. But if my cash position is so efficient, it allows me to say no to way more investments in the future. Next is retirement uncertainty. Retirement's not a word I choose to use personally anymore, because I am living my ideal life. I wake up every day And I cannot say I live without stress, right? Growing requires intentional action, discipline, faith. And so my life is not without stress, but I love what I do because we're mission oriented, we're teaching, we're educating. And I know that these policies get better every single year. So if I ever wanted to convert one of these into a passive income stream for like retirement or passive income years, I could definitely do that. Something a checking account, a savings account would just never be able to do because they're just not that beneficial. And so I don't like the word retirement, but I understand not everyone sees it like that. So if retirement's part of your goal and you're uncertain about it, perhaps part of the equation lies in how inefficient the environments are that you're currently storing liquid and safe dollars. So let's jump over now to a truth concepts calculator. And like I said, if you are working with an insurance agent, I would highly recommend that they use truth concepts and attend a truth concepts training, because this will take your education around not only whole life insurance, but a lot of other assets and break down the actual math behind it, which when you're dealing with finances, the math is incredibly important. So what we're looking at here is a 40-year-old female over a 40-year time frame. Now we're going to assume this gal's in pretty good health. And this yellow column right here on your screen, this is called the annual inputs. This is the premium. I would call that savings. She went through our curriculum. She said, you know how much I can save that's comfortable and affordable is $20,000 a year. Hopefully that's a minimum of 10% of her income, twice the average savings rate. So she's going to commit to paying $20,000 per year in premium. This blue column is the total net cash value. Now I'll tell you, there's about 1,000 different ways you could build and design these insurance policies. So don't let anyone online tell you there's only one true way to do this. That's when you know you're dealing with a salesman, is when they say our policy design is better. What you want to know is you want to work with an agent who's going to ask you, what are you trying to accomplish? What are your goals? And based off what your goals are, your time frame, what you're trying to do, could we build a plan that actually fits that goal and not just sell you like a one-size-fits-all policy? So what I'm saying is this is a very generic kind of run-of-the-mill. This is good for early cash value, and it's great for long-term storage of wealth. Kind of the best of both worlds, okay? Now, you could build policies that have a lot of liquidity up front. You could build policies that don't have any because you're expecting future windfall 5 years from now. So there's a lot of different ways that you could do this. So the blue column represents your total net cash value. The purple column is the death benefit. So you notice they're all going up. Now, I would never look at whole life like an investment, but I would look at it like a business. You see, in the first year of this business, you're going to pay in $20,000. And your business gets the benefit of $656,000 of death benefit. That's the business you're buying. You are buying life insurance. You're not buying life investment, okay? It's a life insurance product. Now, you have access to about 11,000 of that in the form of cash value. You could relate that to like equity in your home. Your home has a sales price and it has equity. And so people get this wrong too when they're like, well, if I pass away, do I get the death benefit and the cash value? That's like saying if I sell my home, do I get the sales price and the equity? No, you only get the equity if you were going to sell it or walk away from that, okay? So the cash value and the death benefit are actually the same thing. So the way the contracts work, and we'll just pull this out for good reason. Let's go out like 80 years. You see, the way the guarantees work is when you buy life insurance, you're buying a death benefit. Now, if it's designed where your dividend option is buying paid up additions, you're going to see a constant increase in both cash value and death benefit because they are the same thing. So the way the guarantees work is when you buy a policy, you're buying a certain amount of death benefit. And as you pay premiums, the company has to guarantee that your cash value and your death benefit equal each other by the end of the contract, which is why you see those lines get so close there. So if we take this back to 40 years, the more that you're paying in premium, the more that it buys in death benefit, and the more your cash values are going to increase. And once this clicks in your brain, this is why you're like, okay, I just want to get as much into this as possible, especially after a few thorough readings of becoming your own banker. You're going to hear people say, like, I try to get all of my free cash flow into life insurance. I'm currently at that stage right now. And so this is how I look at it, is like a business. Every year I'm paying in the same fixed expense for my business. So if you could buy a business, the expenses never went up on it because it's guaranteed, but it was guaranteed to have a positive annual cash flow. You see this column? In the 10th year, you pay in $20,000, it grows by $26,000 that very year. My policy I showed you earlier is literally doing the exact same thing. And so the only unfortunate part about this policy is that it can only hold $20,000. I would love to put $200,000 into this policy, but that's why if you're reading Nelson's book, he says you want a system of policies in here. You'll start with one. Once you get your feet wet and you get a feel for this, then you'll start to expand the system. So that's kind of how I would look at life insurance. Do not look at it as an investment, like what's the least I can put in to maximize it. You're not thinking like a banker, you're thinking like an investor. And so let's calculate possibly the most misunderstood benefit with life insurance, which is the yield. So like I told you with my old policies, that one I showed you, I'm earning about 3 to 4% net, and it's a very long-term internal rate of return. So most policies you're going to be buying today in today's environment are going to earn probably somewhere close to 3 to 4% long-term. We're looking at this over 40 years. And you want that. You want a long-term stable asset that you can always rely on. Now remember, this is a net number, a net 3.42, meaning all the fees and all the taxes have already been accounted for. So that's what you're actually earning. That's real to you. Contrast this to another liquid safe asset like a CD. And I'll give you a real story. I was at Chase Bank a couple years ago. We were privately financing a vehicle within the family. So I took a policy loan, got the cashier's check, was taking it to Chase Bank, and they had an advertisement for a CD, a certificate of deposit. And they said we were paying 5% on the CD. So I asked for some information, and what I found out was that CD had a 1% management fee on it. So if they're saying 5, now you have to subtract the 1% management fee, so you're really earning 4 net. So what this calculator does, this is called a funding illustration calculator. It's now calculating up here at the top the alternate interest rate needed to match the permanent cash value, which is now 4.47. So in order to be equal to, not better than this life insurance contract, that CD with a 1% management fee would have to pay 4.47. Now, let's assume I'm in a 30% tax bracket. You see, this is why people are so confused, because they don't have the right education around this. When you factor in taxes and management fees, what this is saying is that CD would have to pay me 6.41% gross every single year for 40 straight years to not be better than, just be equal to that life insurance contract. And that's not even assuming all the other benefits, guarantees, the death benefit, the loan provision, the private nature of the asset. And so hopefully this video helped you understand probably the 3 biggest misconceptions around life insurance is that it's got a low rate of return, it's expensive to own, making it the worst investment of all time. So when you know better, you can do better. Make sure you get enough education before you go out and buy any life insurance policy.